One of the best ways to understand this difference is to visualize their returns. For example, let's say that you were looking at buying a stock of Plain Bagel Corp. A great company I hear, but I'm not supposed to give my opinion. If you buy the share, we can graph how your total return will be affected by movement in the stock's price. And, well, that's pretty boring. But it makes sense. Because you own the stock, any dollar increase in the stock's price will be a dollar added to your return. The slope crosses the x-axis at the price you paid for the stock, which we'll say is $30, meaning that if the price doesn't change, well, you make $0. Great, so now let's look at a call for a Plain Bagel share with the following stats. If we plot the return, it looks a bit more interesting. As you can see, the two have similar upside potential, though the $2 premium you pay for the option brings it slightly below the shares line. This upside happens when the stock's price falls above the option's strike price, aka when the call is in the money. Because in this area, you can buy the stock for the lower strike price and theoretically sell it at the higher market price. But look at the downside risk, or lack thereof, with the security. You'll notice that if the market price of the stock falls below the strike price, aka when your call is out of the money, the most you can lose is the premium you paid for the call. This is because an investor doesn't need to exercise an option if doing so would not be profitable. If the stock's price falls, you can just let the option expire. Puts work in a similar manner, but since they entail the right to sell a security, the graph is actually flipped. If a stock's price falls below the strike price, you could buy a share at the lower market price and exercise the put to sell the share at the higher strike price.